everyone, and welcome to our YouTube channel, Moneyline with Nancy at TV. In case you're not a subscriber yet, please do subscribe. Just press the subscribe button as well as turn on the notification bell so that you can get notifications when we upload our videos. Don't also forget to subscribe and join, follow, like our other social media platforms. Of course, you're seeing it right about now. Don't also forget to share this video across your platforms. Enjoy the video. All right, welcome back to the program. Felicia Awolope is joining me right now. She's the lead economist at Meristem Research. Hello, Felicia. Welcome to the program.
Hello, Nancy. Thank you for having me.
Now, let's start with the big picture of Trump's tariffs impact before we'll zero in to Nigeria. What's your assessment really of the global impact so far? If you take a look at what's been happening since the announcement of the aggressive tariffs on countries all over the world, including where human beings do not live. You know, when I saw that, I actually I was smiling that this man means business. And what spillover risk do you think are there, especially for emerging economies such as Nigeria?
Thank you very much for your question. I mean, the U.S. is a major player in the world trade, in the world trade scene. And so when policies are rolled off, trade policies from the U.S., of course, it holds like significant, repercussions and implications for global trade, for the global economy, and for the economies of these different countries. Seeing the U.S. impose tariffs on imports from a lot of these countries could actually slow down the dynamics for global trade. Bear in mind that global trade just involves trade agreements between different countries, different parties and entities. And when there's friction, when there's a difficulty in the execution of these agreements, it just slows down the pace of global trade. It could lead to disruptions in supply chains. If there's a company in the US that has to import its raw materials from any of these countries that has been levied tariff on, then it could result in frictions on trying to get raw materials. It could impact output for countries in the US. It could impact demands from countries that actually export to the US. It holds diverse implications. And one thing that happens when things like this come up will be that investors will become uncertain about policy direction. What could be happening? How would this impact the economy? Does it have any implication for the equities market? And people become jittery. Investors don't know what to do. And when people are risk averse, when the risk in even safe economies, is high, sometimes it could drive investors to want to take capital flights from emerging economies to safer assets to just guide against, potential escalation in these uncertainties.
I mentioned at the beginning of the program that this Trump's aggressive tariffs did not impact energy products, including oil and gas. So he smartly avoided oil and gas in the tariffs. But how do you think that this risk will still impact the market, the oil market? Because we've seen Brent crude, for example, trading at around 63, 62 US dollars. I've been looking at global markets in the last few days. It's not been a very good one. Red arrows across board, even this morning, concerning global markets. We're seeing a whipsaw of global markets, including commodities and all of that. So how do you think this would even impact the markets moving forward, despite the oil and gas being excluded?
I mean, well, like you mentioned, we excluded oil and gas products from, products that these tariffs are actually going to be effective on. And while you'd expect that to sort of maybe calm investors or just assure the markets, this coming as at when the OPEC announced plans to actually increase supply, something that has triggered a downtrend in oil prices. So we've seen, global crude oil prices go as low as 61, even below 50, below $60 per barrel at some point since the tariffs were announced. And it just comes to, there's a probability of an increase in supply, and that is coming when it looks like demand could actually reduce. And so this, if you marry these two together, people are worried, players in the market are worried on how global oil prices remain competitive. And we're already seeing a couple of research companies come up with their forecast for global oil prices. And if you look at the prices, their forecast rather, it's slightly below their initial forecast. People are beginning to, or companies, investment houses are beginning to revise their global oil prices forecast due to all these uncertainties coming, with a proposed increase in supply by the OPEC plus.
Let's take a look at Nigeria now, and the federal government has definitely set key assumptions for 2025, and it was costing well at the beginning of this year, where we saw oil price trading at over 70 US dollars a barrel. I just looked right now. Brent crude is trading as I speak at 60 US dollars, so we're already $15 down in terms of deficit. How do you think that this would impact government? That's the federal government now, 2025? Budget assumptions in terms of oil price, in terms of growth outlook, what else again, perhaps even in terms of inflation?
I mean, if you look at what we forecasted and what the reality is playing out to be, then there's a deficit, and this deficit means there might be, lower oil revenue for the government compared to what was forecasted or what was budgeted. And this just means that fiscal deficit has increased. And of course, this deficit has been funded by borrowings. Of course, typically it's always been the case that sometimes budget assumptions, underlying different annual budgets by the fiscal authority has always, proved not to live up to its expectation. What I mean is that over time, sometimes we've seen that what we budget or what we project for our budget assumptions is typically not the case. And this is just another case of that playing out. And it just means that fiscal deficit would increase, and what the federal government will need to borrow to be able to make up or meet up with its expenditures would, of course, increase. This could mean increased paper supply for the fixed income market. This would mean higher public debt burden for Nigeria as a country and increased debt servicing cost, of course.
Let's talk about the impact on states, because if I'm a state governor, I would be agitated at this time. Why? Because majority of what we sell is crude oil. Of course, is excluded from the tariffs, but we're also seeing partner countries like China and some other countries being affected by this Trump tariff, war, as it were. Do you think that because of what we're seeing right now, especially in the oil market space, that it will impact revenues to states? Because if you take a look at FAC allocation in the last perhaps 1 year or so, the federal government, states and local governments have been sharing in excess of 1 trillion, about 1.5, 1.6. There was even a time the vice president actually told a gathering which I moderated that there was a time they wanted to share 2 trillion naira, but they had to hold it not to overheat the system. So what do you think would happen right now to states in terms of FAC allocation monthly?
I mean, it's, of course, looking at how this plays down, if we see lower revenue as a country, then, probably what is available to actually be shared by the 3 tiers of the government could actually moderate also. However, another thing would be how the federal government is planning to fund, these deficits. Are they going to moderate expenditures? Are we going to be seeing lower expenditures? But definitely, or likely, most likely, we might be seeing lower figures if there is, less foreign exchange revenue, less revenue for the federal government. It could actually impact the amounts that, will be seen to be shared by these 3 tiers of the government going forward.
How do you think that the Naira will cope in coming days? Because we've seen FX interventions by the Central Bank of Nigeria. Do you think that the Central Bank of Nigeria has the continuous war chest to be able to defend the Naira moving forward, even though we've seen a slight appreciation, but that is not also okay in terms of where the range where the Naira is at this time, around 1,615 to 620 Naira to the US dollar?
And thank you very much for your question. I mean, as a country, our major source of foreign exchange income still remains oil. And so if oil prices are going this low, and we are not seeing any significant improvement in oil production that could maybe cover up for this decline in oil prices, that it means that foreign exchange income or foreign exchange inflow from oil receipts, are particularly dissipating or declining. And that means less capacity for the CBN to actually continue to defend the Naira in the exchange rate market. So yes, we've seen some level of appreciation, and if you agree with me, the appreciation and the stability we've seen can be majorly attributed to the continued intervention of the CBN in the foreign exchange market, as well as to a large extent, improvements in foreign investor sentiment and all that. But the bulk or the major reason for this stability and the appreciation we've seen would be the CBN's continued intervention in foreign exchange market. And if their capacity to intervene should decline, it could mean that we might not be seen as more frequent intervention as we've seen, or it could mean that the foreign reserves will be depleted. How long would we continue to deplete the foreign reserves to defend the naira? How sustainable is this? Is the question that now comes up. And if you ask me, we need to work on diversifying our source of foreign inflows as a country to be able to cover up for that gap that might come up due to lower oil prices.
How should Nigerian businesses respond? Because for exporters, however you look at it, exporters of perhaps non-oil products, businesses that are involved perhaps in manufacturing and import-dependent sectors, how do you think they are likely to be affected by this in terms of cost and access to inputs as well as profitability? And what do you think would also be the effect on inflation moving forward? Because if we take a look at Nigeria's inflation rates for this year, from the rebased CPI, it's trended downwards, even though inflation is still high. So we shouldn't be deceived that inflation is coming down, or the APC government just be telling us this, that inflation is coming down. It was rebased, but we're still within the 2 digits, which is not good for a developing economy. So what will it, how will it affect inflation, the inflationary pattern that we're seeing like on a downside, having in mind too that the Central Bank of Nigeria is of the view that inflation is moderating to the downside? Two questions.
Okay, so taking this step by step, looking at the exporters now, people, the players and the people who export, players who export non-oil products, to US, it could mean that their prices, the prices of their products will no longer be as competitive as it used to, because of the tariff that the US government has levied against on Nigeria, the 14% tariff. And this could result in maybe a shrink in demand, which could actually reduce foreign exchange inflow from that aspect. And looking at the importers, one way that this could affect commodities price generally in the global market is if we see significant disruption in global supply chain, if countries rather begin to try to reroute their trade supply chain because of the tariff, and begins to increase maybe the period before goods get to their destination countries, it could lead to higher prices. And when commodity prices trend higher, input prices for companies generally would increase, and this could lead to cost push inflation, which is one thing that we've been dealing with in Nigeria. If you agree with me, when we saw the Russia-Ukraine war that came and disrupted global supply chain, it led to higher prices of key commodities that come from that region. And so depending on how this plays out in the global space, how countries are able to, if countries decide to negotiate with the US government, or they decide to form other alliances to divert trade routes and all that, it could result in higher commodity prices, which, bringing that to Nigeria, would mean higher input costs for manufacturers and people, import-dependent, industries. And then this would mean higher cost of production and could translate into higher prices of goods and services, which could exacerbate inflationary pressures for the country as a whole.
Now, finally, what's your outlook for Nigeria's macroeconomic stability? That is seemingly also a bit shaky. We're trying to be stable, then consolidate, then perhaps accelerate, especially as we're still reeling from the impact of the removal of fuel subsidy and FX subsidy. So what's your outlook for Nigeria's macroeconomic stability in this time of global protectionism, perhaps for business owners, as well as even investors, as well as policymakers? What should we be doing to stay ahead of the curve right now?
Thank you very much for your question. Coming into the year, we at Meristem, we sort of expected to see more stability in terms of volatility in prices, even for the exchange rates, due to the fact that, last year we saw significant shocks, like you mentioned, the official or total removal of fuel subsidy just made fuel prices move from around 500, 600 to over 1,000 at a time. And that's, sort of worsened things for at least it puts significant pressure on price levels for the country. And even the depreciation of the naira from around 900 at the beginning of last year to 1.5 by the end of last year was another major trigger for price levels. But coming into this year, our expectation was for more stability relative to what was
So you guys
witnessed
at
last
Meristem
year.
did not even you guys did not think Trump was going to do this? Because
No,
for me,
so
I
I was
sort of
going to,
knew that because he's been saying it all through his campaigns. Do you understand? And
yeah.
everybody in the world knew that Trump is going to be back, Trump 2.0. So you guys did
I
not
was going
even,
to finish.
yeah,
No, I was going to finish that. But
okay.
our expectation was that, a shadow hanging over this outlook would be when Trump wins the election and he comes with policies that is geared towards strengthening the US economy, which could have severe impact on other economies. And of course, so we made a provision that, there are certain risks that could materialize and could, of course, change the dynamics. And if you agree with me, we're beginning to see some part of this resource, some portion of this risk materialize. And what this will mean going forward is that people have to be cautious. Investors have to, for investors, I would say investors should, look at the fundamentals of companies, maybe for equities markets, for the fixed income market. This could bode well because when at a time when risks are high, people tend or investors tend to just flow to gyrate towards safer assets, which in case of Nigeria would be fixed income instruments. And also, like I mentioned earlier, if we're going to see increased paper supply, this could mean more activities and improved participation for the fixed income markets. But for businesses, this will be the time that businesses will want to be able to intensify their backward integration efforts to protect themselves against volatility in the global space. Global commodity prices would rise. We could see movements in the exchange rates, which could increase cost also for businesses. So this would be the time to sort of maybe intensify backward integration efforts to sort of come up with strategies and policies that would protect their businesses from, and I mean, if you agree with me, last year, 2 years ago, we saw how the depreciation of the naira, increased commodity prices impacted the manufacturing sector for Nigeria. And we've seen some of these companies actually come up with policies and strategies that are company specific to sort of edge themselves. Companies paid down their debt to make sure that they have less, exposure to volatility in the exchange rate as it will increase their foreign debt balances and all that. So what I would advise would be companies to continue to intensify these efforts. If you can intensify your backward integration, program and strategies, this will be the time to do so. If you can, come up with forward contracts and all that, that would help mitigate the impacts in case we see significant escalation in dynamics in the global space.
Okay. Thank you, Felicia. Let's continue to watch the space. I hope it doesn't get hotter than this or redder than this. But let's see what happens. Thank you very much. And say me hi to your colleagues over there.
Thank you very much for having me.
All right. I've been speaking with Felicia Awolope, who is the lead economist at Meristem Research. Thank you for making it up to this minute watching the video. Thank you all. Don't forget to subscribe to our YouTube channel, Moneyline with Nancy TV. Like, follow all our other social media platforms where we keep you up to speed with fantastic interviews, as well as markets, personal finance, business, and economy information. This is the best place to be. I'll see you all again in the next video.